What is happening, best ever listeners? This is Matt Faircloth, and welcome to the Next Level CRE segment of the Best Ever CRE show. Guess what? Thank you. That's what I got for you. I'm giving you gratitude for listening to this show with me on the Best Ever CRE network. You know why? Because it's best ever. And this is a best ever episode, y'all. So put your seatbelts on. This is going to be a really cool show. Before I get to the show, I got two things I want to ask y'all to do. If you're not a subscriber to this show, seriously, this episode could make you millions of dollars. This episode could make you millions of dollars. What other podcast are you listening to out there that could make you that kind of money? So go and subscribe to the Best Ever CRE show right now. Be a subscriber. Join the cool kids, because there's a lot of episodes coming down the pipeline, including John Chang telling you where the economy's going, John Kasman telling you about going to multifamily mastery, my man Ash Patel and Amanda talking about beyond multifamily. That's okay. We'll forgive them for talking about that. It's all good. And lots of other hosts too. These episodes are made to help you build your wealth and your businesses. So subscribe right now. That's the ask I have for you. And the second ask I have is get off your butt and register for Best Ever Con. Do you guys know this is the 10th best ever? BECX. It's like a WWF thing or like a Super Bowl or something. Maybe me and Joe Farrellis will come in and wrestle for a belt in the middle of the conference or something like that. Probably not. But BECX, that's what it's going to be. Join the cool kids. Register for Best Ever Con now. There are still early bird discount tickets on the website, bestevercre.com. And join us at Best Ever Con, because I will be there. A lot of the other folks will be there. I'm going to ask today's guest to be there because he damn blew my mind. This episode, as I said, is a way to make a lot of money. I want you guys to listen for an adage here. Okay. And this episode is going to be all about this. Observe the masses and do the opposite. That is how you get rich, is you observe the masses. Everyone's doing a thing. Everyone's running away from multifamily. Everyone's not investing. Everyone's sitting on their hands and waiting, whatever that looks like. You know, they observe the masses and do the opposite. So if people are doing one thing, find a thing they're not doing. And that's what today's episode is all about. We're going to talk about an investment strategy I doubt you've heard of before. And I doubt you've heard of, certainly from me on this show, but it's something I've actually researched. I'm excited about. I'm leaving you hanging. So let's bring our guest in and he'll tell us about this investment strategy. I know you guys are all on the edge of your seat. So let's bring in Chris Zona today for the Best Ever CRE show. Best ever listeners, I am excited to have our guest today on the show. And I'm walking in blind, and I want you guys to join me walking in blind on this one, guys. Great write-up on my new friend, Chris Zona here. But I want to just jump in and have an open-ended conversation. And here's why. Chris is a partner with Mandelbaum Barrett PC in New York City. He's a trial attorney. Oh, I'll behave myself. All y'all behave yourself too. Specializing in complex commercial litigation. Okay. Now, Chris, talk to me. Why is now you're also not a syndication lawyer, right? So if I want to, like half the time when a lawyer's on a real estate podcast, it's because that they need somebody to set up an SEC, structure for themselves so that they can go and raise money, right? That's not what you do, correct?
Correct. So,
all right. Okay.
Yeah,
you're going after people.
What's that? Most of your listeners are going to deal with lawyers, doing diligence, helping with them on structuring deals, on deal making. And that's the majority of commercial real estate.
Happy times, right, Chris?
Exactly.
I'm forming opportunities. Like I'm raising money. I'm growing. I'm doing new things, right? Yeah. Okay.
Yeah, no one wants to involve guys like me.
Okay. What's a guy like you doing on a real estate podcast?
Sure. So that becomes a lot of it, right? Forever, litigation is a cost center. Nobody wants to involve litigators. We come into the situation, either you've been harmed or you're in trouble. So constantly litigation is really a cost center for investors, for companies. And where I have seen and I've started to work with a lot of clients is to change that perception. And we've seen a massive change with lit finance, third-party finance over the past 20 or 30 years. But within specifically the real estate realm, I've started to see that there are a couple avenues for investors, whether they be large real estate funds who have a lot of capital to deploy, or smaller one-off investors to try to use people like me to help them get into properties that perhaps they couldn't otherwise do on the open market. So that's really where I find that litigation and litigation attorneys like me who are actually in court, trial attorneys who want to be in court, who want to file papers, who want to be aggressive, can actually help build capital, build appreciation, build returns for investors, rather than always being on the protection side and being an expense at the end of the month.
Okay. Are you but before we get into how you can help us get deals, got my attention there. Are you the lawyer that a business person like myself or like our best ever listener would go and throw at a problem like, oh shit, Chris, I just got sued. Oh man, I'm busting up my partnership because my partner's a piece of garbage and I need to, they stole from the company or I got to exit from this partnership. I need to throw a lawyer at this partner, right? Are you that kind of attorney as well?
Yes. So
Okay.
that's really where I got my start in this, right? And that's where a
Mhm.
lot of my contacts come in is someone, a fund comes to me, XYZ is happening. And as I've had more and more clients like that, I've started to see that, hey, there's an opportunity not just to view me as the person you go to when things go wrong, but to view me as someone who you can utilize to help you build whatever strategy you want to employ. And, we're all used to the transactional attorney who can write up documents, and that's well and good. I don't do that.
Yeah.
I help people mostly, I call it kind of hostile takeover strategies. And whether that's for an end game of an exit from a property or an end
Okay.
game of keeping the property and turning it around, I am kind of using the litigation format as part of your kind of portfolio of acquiring properties for whatever your end game is.
Give me an example. Hostile takeover. I like it. This is like Richard Gere, Pretty Woman kind of thing, right? I like it. Okay, so keep going.
Sure.
Hostile takeover real estate. Give me a scenario that you could tell us about.
Sure. So I can give you kind of two because they're the two most common that we really see. And I'll give you
Okay.
kind of the most common and then what I've been pushing a lot more investors to look at. So the most common we see is a hostile takeover with a kind of a short range exit. And what that looks like is, as we all know, mortgages are commonly bought and sold on the
Hmm.
secondary market, right?
Securitized.
All the time, right?
Yeah.
If you have a mortgage, sometimes you're paying it and all of a sudden you get a notice from your bank or your credit union. Hey, start making your same checkout to this other person,
I've had that
right? They
happen
want
like
to
a week
de-risk.
after closing. A week after closing, I get a letter saying like, "Hey, you're now dealing with Wells Fargo." And sometimes you get a letter from KeyBank, and you're like, "Damn it, I hate KeyBank." But KeyBank is now like, they're the worst. They really are. But anyway, so you get these letters, right? It's something, and half the freaking time, the originator, be that whoever it is, XYZ Bank, still services the loan, but they sold it off to a whole portfolio of securitized whatever mess like a big pool of loans behind them, a la The Big Short kind of thing.
Exactly.
So yeah.
Right.
Right.
And they want to de-risk. So banks often want to
Sure.
de-risk.
They want
And they
their
want
money
to
back.
de-risk on a lot of
Yeah.
times, they want to de-risk on performing loans, so PLs and NPLs, non-performing loans. And
Sure.
non-performing loans are generally a loan that after about 90 days has hit some sort of default, usually a payment default, but some sort of default.
Keep going. I like it.
Yeah.
I see where you're going. And I
Yeah.
think one
So
of the best ever
exactly.
listeners
So
that haven't, and let me just break it down real quick for best ever listeners that don't understand what me and Chris are going, because me and Chris are at like not even level 202. This is like graduate level finance, right? When a loan gets originated for any type of property, the originator of that loan is likely who lent you the money, or they maybe got it from a line of credit they had or borrowed it from somebody, and they give you the $10 million or the $200,000, whatever it is, for the property to get that loan off their books, to de-risk their books, and also, as I was alluding to get their money back so they can go and give it to somebody else, right? They will sell that loan as part of a package. They'll put it in like a big bucket of other loans that they've originated, and who is it, Chris? Like a private equity fund, or who typically buys these big buckets of commercial mortgages?
yeah, a lot of times it's private equity funds
Okay.
nowadays, right? Or
Yep.
or bank backed funds. They're buying performing loans because at the end of the day, they want a return on that investment that's consistent and over the years.
I just want to explain what servicing was, right? So to the best of our listeners. So sometimes they're the originator, be that, let's say, Wells Fargo, right? Wells Fargo keeps collecting payments from the borrower, from me, from you, from anybody, and then they send it off to the owner of that bucket of money. The bucket of money likely doesn't want to collect the monthly payments. They don't want to deal with escrowing for taxes and all the jazz. All that's called servicing. and they likely take a fee or whatever it is, but there is somebody else owning that bucket of money behind the originator of that loan. I am not very well aware of what happens to that bucket of money. So do tell me and all the best ever listeners that there's this bucket of money owned by private equity with a whole conglomerate of loans in it. Tell me how we turn that into a corporate takeover.
Sure. So that's a lot of performing loans.
Yeah.
Now, there are also NPLs, right? Non-performing loans.
Mm-hmm.
And those non-performing loans, you can go and look for them. I mean, the best way to do it is through, banking relationships that you have with banks so you can understand the market. But there are a lot of third parties that have sites that list out non-performing loans. There are several major ones that you have to subscribe to, of course. But there's also, Fannie Mae has an accessibility to do it. So non-performing loans are being sold generally below par. So below that 100% loan value, because at that time they kind of raise their risk, their kind of risk matrix for whoever either the owner of the loan is. So whether it's the initial mortgage holder or a secondary holder, they're reselling again because there's some sort of non-payment or some other default. Generally, NPLs are usually going to be non-payment. So the opportunity there within kind of real estate investing, that's been a common opportunity, in the main strategy is, hey, let's go buy either a non-performing loan, or if you raise enough capital and have that ability, a bucket, just like you described, of performing loans. You buy a bucket of non-performing loans for, say, 10 multi-unit properties in a good real estate space. And you then can enforce the obligation and covenants within that mortgage. So if it's your standard would be a payment. So if you have default payments, you could obviously enforce that. And a lot of these loans are written very strictly, where the obligations are very strict. And what you would do is you then employ someone like me to say, hey, go and foreclose on this property. Depending on the state, there are different foreclosure procedures, but go and foreclose on this property. Let's take it over. Since we bought the loan at below par, so say we bought at 65%, we can then credit bid at an auction the full amount of the loan because we own the full amount of the loan.
Wow.
Pay almost nothing out of pocket. And now we can take deed to that property at 100% of value of the property, buying the mortgage at 65%. And with the right diligence, the common strategy there is to then exit the property within a short period of time so that your investors see returns. Exit the property at, say 90% of property value. You bought at 65%. And now you're seeing kind of this great spread for your investors, and you're exiting the property with monetary returns. That's a common strategy, and that's really the main way that we as litigators are utilized, and kind of what I've seen within the industry. What I haven't seen, however, is funds using or investors using a second strategy, because a lot of investors don't want to do that, right? That is a very aggressive means by which to operate. It means that you're answering to investors who want immediate returns, and it creates a lot of stress on IRR and what your return to your investor is going to be, and litigation expenses. A lot of investors want capital appreciation. Hey, we want to build out a portfolio. I want to go from 5 to 6. And I'm tired of scouring the pages and trying to find the right deal on the open market and dealing with so-and-so and trying to, overcome this or that. Okay, well, what I've been pushing funds and investors to understand is this same strategy can help you access that same property that isn't on the open market. And I call it a hostile takeover. One, because I like the aggressive sound. I think it sounds good. Two, because you could potentially do the same thing. You can enforce those same covenants once you own that loan. You're at a less than par value on the loan value, and then take that property over on a credit bid and then just remanage it.
What's a credit?
You don't have to then exit.
What's a credit bid?
So a credit bid is when you own the mortgage, and when it goes out to auction, you can bid whatever's owed to you.
Okay, so you bid
I
buy a mortgage for $6.5 million that has a par value, meaning they were lent $10 million. So I'm at 65% loan value, whatever, and it goes up to auction. I go and I bid against the market, and people are up there bidding like 7, 8 million. I can bid up to 10 because my cost basis is 6.5. So I can take the property over for a lot lower cost basis than somebody else could. Got it. Have you ever seen
Yep.
anybody do, or have you been assisted anybody doing going direct to the borrower and saying, "Hey, let's, you got a couple options. How about I've thought about this a bit. Like, what if you can get them to get current, right? My cost basis is 6.5. If I can get them a new payment plan to get them current at a debt service of 110 million, right? Even if I negotiate their rates down a little bit, whatever it is, my cost basis is 6.5 and they're paying rate on a par of 10. And so I'm already making a better yield spread than I would if they're paying 7% on 10 million. 7% on 10 is going to pay me really good on my investment of 6.5 million, right? I'm probably into the double digits,
100%. And that is 100% of the strategy that I've been pressing more and more people to understand is that if you're willing to do that,
Yeah.
you can set yourself up to either increase the size of your portfolio or generate a portfolio where you become a little bank or you
Totally.
become a little mortgage lender. And you can then make sure the property, hey, if you believe that this NPL is going to turn around,
Yeah.
right, through your relationships or through discussions with the
Mm-hmm.
borrower, you understand, hey, the reason they're defaulting is, say, cash flow, right? The industry is kind of down, but the forecast is that cash flow is going to come back.
Sure.
Cool. A bank doesn't want to wait. A bank's not going to take an
They're
NPL
done.
for 2 more years, but maybe you're willing to, and maybe you have a vision. Hey, I really want to be in this particular market, and at this value, what I'm forecasting 5 years down the road is going to be a very, very profitable proposition for me.
Mm-hmm.
Cool. Do exactly what you just described. You then negotiate with the borrower, or conversely, you negotiate with the borrower to kind of sell out of their mortgage. Say you buy at 6.5 and they're like, well, can I buy the property from you and own outright at 7? Okay, maybe 500 on that return is pretty good for you,
No,
right? That's a
no,
pretty good return in a short
8
period of
million,
time.
8 million. I'm not taking 7. I want 8, Yeah, no, I
No,
get,
100%. But
but
you get the
you could,
idea right
in
away.
essence, you could say, I will do, this is a term that the best ever listeners, you guys might not even know this term. I've been investing since 2005, and there's a concept called a short sale. And Chris, nobody talks about that anymore, but that used to be the only way to get deals done back in the day, right? And a short sale is where a bank or a lender would sell a property short of what par value is. So if I own the debt at 6.5, you're right. I could go to that seller and say, hey, or to the owner and say, listen, if you can get me out at 8 and get me out in 30 days or something like that by going to hard money or going to another bridge or whatever, I'll give you a payoff letter at 8 million, and then I make a quick 1.5 from me and my investors, whatever that may be. That's perhaps a possible out because then they get to hold their property, preserve their equity. They get to go and live and fight another day, right? And that's all great. I kind of hate this idea, but I'd also thought of what if, like you said, they're kind of short on capital. What if I go to them and I say, listen, what if I lent you a pref equity tranche? Like, what if I come and what if I bankroll you again and I go in with a second position in that? Now, you could be throwing good, but the reason I hate this, Chris, is because you could be throwing good money after bad. But the property could be worth 10 and I'm into debt at 6.5 and it's got a lot of upsides. They know they don't want to let it go. And so I just come and get them around the corner. I just have to have some hooks in that pref equity agreement that if they screw up, I can go and take it back from them. Right? Have you seen that done?
Yeah, I mean, that mezzanine debt, kind of all of that, right?
Yeah.
Mezzanine debt is where you're kind of in between the mortgage lender. You're secured, but you're not preferential to the mortgage lender. But you can use, UCC 9. UCC Article 9 allows you to kind of skip foreclosure. It's a non-judicial foreclosure process. There are a bunch of different ways, but that's a
Yeah.
great idea. If you have the bankroll for it, then absolutely, right? Why wouldn't you? Once you own the note, you could do whatever you want with it. You can even resell it. If you were to do
Sure.
that and then you don't want to continue to carry the note, you could resell it.
You can
I mean,
flip that.
yeah,
But that's what
it's the interest, it's the affirmative use of really what it comes down to is kind of, and the reason, I wrote a series called Turning Conflict into Capital. And that's really how I view this is that for so long, everybody has the same view of attorneys. You only call us when it goes wrong, or you call us when you want something written, especially with investing in real estate. And it's like, hey, guys, I can help you get into a property that's not in the open market potentially
Mm.
or get you out of a property that's not in the open market, and I could help you with a return. Yeah, maybe you don't want to build your whole strategy on that. I get it. Not every fund wants to be on that. That's very hawkish on the fund type, and you need
Yeah.
to raise capital and be open ended. But say you're in a capital appreciation fund where you want to build long term capital appreciation for your investors or for yourself. Well, if you have 10 properties and you're very good at diligencing them, and you're very good at diligencing how the notes are going to be paid out, why not look into your 11th property potentially being as I'll call it, a hostile takeover
Mm-hmm.
property, where you're utilizing that same expertise, still utilizing your diligence of the market and all that and pricing, but you're just utilizing a little bit different way of acquiring the property. You're getting out of the open market, and maybe your timeline to close is a little longer because you do have to foreclose, and that depends on jurisdiction, right? New York is
Mm-hmm.
obviously harder. Places like Texas, it's not. Places like Texas, it's much faster. So it
Yeah.
really depends on, hey, I want to increase my, say you're in multiple markets, I want to increase my market share in X market. Okay, jurisdictionally this works. This could be faster, and why wouldn't you look at it at least? And I encourage your investor audience to at least think about it, right? There
Mm-hmm.
is this entire sector
Yeah.
of properties that are in here that you could potentially access and utilize the same expertise of
Mm-hmm.
diligencing, and potentially access them at either a lower rate or you couldn't otherwise access.
Are there possibilities on the because the best ever listeners, everybody's it's full spectrum, right? Let's say somebody listening now has the capacity to raise, make it up 500K, a million out of their network, right? Then there's others that are listening that could raise in the 8 digits, right? Is there a possibility at the 500K to a million range to get into this arena, or do you think that this is like? To me, it seems like this playground has a fence around it that says like $10 million, right, or more. Is that true, or can you get into the field with a 500K $1 million investment, maybe a smaller deal, that kind of thing?
Yeah, I think it's open to everybody. Obviously, a lot of it just depends on the ability to access NPLs, to understand that market, and the
Yeah.
desire to diligence that market. That comes with some sort of capital that you need to deploy, and you need to have those relationships. But certainly, and that's why I think it's attractive, because in today's market, trying to get into like a bigger city at 500 or a million is very, very difficult.
Absolutely.
But yeah, it's almost impossible. But if you're on the lower end of this and you want to get in below par and you're willing to, go through a little bit of litigation and go through a little bit of the headache of dealing with someone like me and kind of wait it out, then hey, if you get a non-performing loan that you can default out and take over that property through foreclosure, you have a pretty good feel for it. What if you get in at 40% of par? So now all of a sudden at $1 million
Right.
invested, you're buying, I'm not going to do public math, but you're buying way
Yeah.
above you're swinging
Quite a
above your
bit.
weight.
Yeah.
And then if you want to exit, great, you're going to make a fat return. But if you don't want to exit, now you're sitting pretty. Now you own a property outright that on the market is going to be, $4 or $5 million that you never could have swung. You then can, if you need to pull the money out and refinance it, great.
Yeah.
Now you have cash flow. Or if you want to put a management in place, if you have the capability of putting management in place and then running, and the reason I say management, mostly we're talking about
Yeah.
multi-unit, opportunities within
Of
larger
course. Yeah.
cities.
This is all. Yeah. I think we're talking more commercial. Could be commercial strip center. Could be
Yeah,
multifamily. But multifamily is really facing a lot of headwinds and distress. So I just think because of the market conditions, that's where you're going to see opportunities, right?
100%.
Yeah. So, best ever listeners, I want you guys to really understand, open up your possibilities here in the idea of buying debt. And some of you guys might not know you can buy debt, right? Versus buying a physical property. So, what Chris is talking about is really it's like going to the foreclosure auction and buying a single family home or a strip center or an apartment building, or whatever. And it sounds like there's a couple of options, Chris. You can go and buy that foreclosure, buy this non performing loan, and perhaps even get it performing again. Having a conversation with the borrower, working out a payment plan, getting them from forming. And if you bought it at 50% loan to par, then you maybe get solid at 75 or 80% loan to par to somebody else, to another investor once it's performing, once they've made, what do you think, like 3 to 6 monthly payments? Then it
Yeah,
becomes,
probably. Yeah,
yeah,
six monthly payments, depending on
yeah,
how aggressive. Maybe investors within the industry who take a more aggressive approach, or they want to take an even more aggressive approach, right? Maybe you want to get it performing enough, and they want to foreclose on it because they see it as attractive. Great, you get it performing enough so that it's good for you. But
hmm
say they have a net worth ratio within the agreement where they have to maintain, they personally guaranteed, and they have to keep a certain net worth of assets to guarantee the loan. Say they've fallen below that because they've had to
sure.
continue to invest into the property. Hey, great.
Oh, there's so many, and these loan agreements, Chris, as you know, I'm sure you've read, tons of them, have so many different, covenants in there, like, debt yield and all kinds of stuff. It's so easy to tell a borrower that they didn't say Simon Says, and it's time to, oh, you didn't say Simon Says, that's it, done. I'm gonna foreclose, you're in default, whatever it may be. Do you go on the other side? Let's say someone owns a multifamily and they got a lender that's getting squirrely, or a lender that's not being so friendly or whatever. Do borrowers ever throw you at their lender to try and negotiate whatever it may be, a short sale, especially these lenders that have already securitized these loans? These loans are really the lender is really just a glorified servicer, and the real decision maker is behind them. Do you ever do that kind of thing also?
Not unless it's going to go to litigation. That really, for me, that I push that more to our transactional side because that's going to be more of a deal making. And not to
Yep.
say that our firm. Luckily, I'm at a full service firm where I could push that to individuals who kind of more do deal with either asset backed lending on both
hmm
ends of the spectrum. But I mean, certainly that is a part of it. But for me, because of my litigation chops and kind of just my background, it's
Yeah.
always been the more, hey, how do we create value from this?
Yeah. No, I get it. I get it. And you can't do everything, right? I
I
don't.
try.
Yeah, well, it's tough working with an attorney that identifies himself to be a generalist, where it's like, okay, that means you're going to be like mediocre at all the things. I'd rather have somebody like you that's really great at one thing. And it's like, well, I don't do that. I love hearing an attorney tell me, oh, I don't do that. Because that means that you're focused, you're drilled into a specific part of the trade. And so it's a good thing. You're really seeing people get 35, 40% discounts off of par these days.
Yeah. I
For
mean,
real.
you see
Wow.
non-performing. I mean, think about it from a bank's point of view, especially on large multifamily and some of the decreasing population. So, like New York, you see, funds are coming into New York and buying up buckets of non-performing loans of hundreds of millions of dollars in debt, and you're taking off the books of either the initial bank or a second or third bank sometimes, and you're seeing, usually it's somewhere between 60 and 80% of par. I mean, who's going to buy a non-performing loan at a 20% discount? I don't want that. I don't want
hmm
my, unless it's a phenomenal property and exploding, in Charlotte 5 years ago before it explodes. Yeah, but it's not going to be sold at not 80%. They're going to,
Yeah.
that bank or the secondary lender is going to try to get it performing again. It really is trying to leverage the fact that the majority of these lien holders are not in the business of holding property. They don't want to deal
Mm.
with it. They don't want to own property. So for them to enforce the covenants is an expense. And the end result is I have to own property that now I have to sell. That becomes a huge drag on a bank because if they're holding it, they need to pay taxes on it, they need to declare it, and it's not good on their balance sheets.
Yeah, yeah. No, I get that, right? Like they're not in that business, and they'd rather free their capital up. It makes you wonder, like, how are they able to make money selling so far below par? My guess is, but if you validate this, is that if you got a private equity firm, again, these guys are just ginormous piles of cash they're playing around with, but they didn't get that far by losing money, right? So the way they're going to make money is by selling at 60% of the loan value and then reinvesting into something else and getting their upside. So they must make pretty good returns because they're willing to sell at 60% because they know they can probably make that 40% loss back through the next deal that they can do. Is that a good way to look at it? That like liquidity is what's going to make them money. So getting them liquid again is what it's all about.
Yeah, liquid is king. And if you're talking about those sorts of buyers in this market and then becoming sellers in the market, they've already bought it on the secondary market. So they've already bought below par. So it's not, I mean, very few people are going to private
Right.
equity as kind of a secondary lender. So they're buying it from a bank. And we all know, like, banks will commonly do deals to take losses, just like credit unions. They're going to do deals to take losses up front because for them, that liquidity increases their ability to then extend the next loan to the next person because they always have to have enough capital on hand. So for kind of that initial lender taking that loss, they're really the ones that are making the smaller margin. I encourage that if you're interested in this as an investor, like, you really do need to do your diligence. Like, you really need to, establish your relationships with banks to kind of understand their secondary market and have those conversations. And I encourage them to kind of talk to the borrower. Sometimes you don't want to because it's going to be a negative situation and you're going to press for it. But you want to understand, like, why this is non-performing. Is this something where the bottom's about to drop out and that's why whoever's selling it is getting out? They see it on the horizon and they're giving it to you. If you want to continue if you're trying to do a turnaround, you're not trying to do a turnaround, you shouldn't really care, right? Like, the more non-performing, the better, because I'm going to leverage that non-performance to get a better par value and I want the property.
Okay. Few questions here. When do you get into the game, right? Like, does somebody need to go and find, okay, I got this NPL, non-performing loan, and I'm buying, hey, Chris, I got it at 50% loan to par, yada, yada, yada. I'm already under contract on it. Do you get in then once they go ahead and buy that note, you help them discuss their options and then help them, throw the book, so to speak, at the borrower and all that? Or do you get in with people that have capital to place and help them find loans that would work for their placement for what their allocation is?
So obviously I could help at any point in the process. I think that it's most useful to actually view it as a strategy. And that's not to say that I'm going to be utilized in every single deal. But if you're looking to utilize this as a strategy, like, you really do need to understand, because jurisdictionally, we need to understand, hey, what jurisdiction are you thinking about buying in? Because then I'm going to be able to advise you on, hey, what's your real timeline to see a return, to see, the takeover to actually occur, what your timeline is going to be for payout, some of the downfalls of this process along the way. So obviously the earlier the better, but that's not to say, at the end of the day, it's your business. And
so somebody get in, they can be like, hey, Chris, I want to be in Houston and I got X amount of dollars to spend and I want to be in Houston, Texas. And you could say, okay, here's the websites that I know of that have NPLs on them. Here's some people that I know that deal in this kind of thing. Let's scour through. You would get in that early into the game.
Yeah, exactly. And I think that's the best time, really, because, hey, you may be looking at 3 or 4 options and strategies within Houston, and I'm just one of them. Right. Unless you're making this your sole strategy, obviously, then you're going to have me, on retainer, and I'm going to be helping a lot more. But if you're looking to kind of bolt me on to whatever strategy that you're already employing, then absolutely, hey, take a look. And at that time, we're not filing anything. So, fees are going to be, they're going to be fees, but they're not going to be exorbitant because, as I said, I'm a litigator. Like, I'm not going to run your numbers for you. I'm going to give that to you. I'm going to advise you on, hey, here are going to be some limiters that you need to take into account. But, you're the business person. My clients, I want to trust my clients as business people, and I only want to impede on their business if it's going to protect them or I can make them more money.
Yeah. It sounds like there's folks that would be a good avatar for this and folks that would not. I'm just thinking of who fits in this bucket, right? Help me figure out what the ideal avatar for someone that would want to get into buying. I mean, must have brain damage to want to go and buy non-performing commercial notes in today's marketplace. I totally see the opportunity, but it's got to be a certain avatar. Help me talk through what do you think are the keys to success for somebody that's thinking about, oh crap, this conversation sounds interesting. Maybe I should hop in. Tell me what the like key factors that they need to have in place before they go and reach out or get into this game.
So one, I think it shouldn't be your first investment in this industry. I think you really need to but you really need to have a standardized due diligence process and understand like what this really means, what a non-performing loan really means for you and what it's going to take. And you have to have the stomach and the wherewithal to bear through the process. It's not fun. And a lot of places that, individuals are looking for the major returns like New York City, it's not fast and it's not guaranteed. So if you're looking for, hey, I want guaranteed monthly income, this probably isn't for you. This is for, in my expectation or my estimation, this is really for one of two things. Either a a fund strategy where hey, I think I can raise, X million dollars.
No, what's X? Give me X. What do you like? Yeah, I'm telling you, like, because
Depending on the
again,
jurisdiction.
there are best ever listers right now on the edge of their seat saying, "Holy shit, I love this guy, Chris. I'm going to call him right now, and I can raise $100,000, and I've never done a real estate deal before, and I think I'm going to put $100,000 in and make 10 million on buying a distressed mortgage note." Let's talk them out of that right now.
Sure.
Okay, let's talk them out of calling you. What is a good? I get if somebody could raise 100 million. God bless them. Somebody could raise a little bit less, whatever it may be. What's like a good buy, like strike price that you think somebody should at least be able to aggregate to be able to make a real play into this space?
Depending where you're looking, right?
Yeah.
It's obviously going to be where you're looking. But
Sure.
I would say if you're really looking at kind of a great return and you want to make this your strategy, then you
Yeah.
need to have the ability to raise capital. I would say over 10 million.
Okay.
And you need to aggregate that if you're going to make this your sole strategy, because what it's going to require, it requires just carrying costs, right? Like it's going to take time. So you need to be able to deploy capital. You need to be able to explain to your investors that your time horizon for this return on the different pieces that you're putting into place is going to be X, Y, and Z. And you need to employ this in probably either in several jurisdictions or on several properties so that you can spread out your returns, right? Like, no one wants to have all your returns coming on day, 150. And then from 100, then I need to identify new opportunities.
Yeah.
What you want to do is you want to kind of structure it so that you're getting kind of a consistent return for yourself and your investors. But that's only as an immediate strategy if that's really what you're doing. If you're not just doing this as your strategy and you want to build capital appreciation and add to your portfolio, I would say if you own 3 multifamilies, and I don't know what your net worth is, but you own 3 multifamilies and you're looking to access, say, from 3 to 6.
Yeah.
And you have the capital to then go from 3 to 6. In my opinion, you're selling yourself short if you're not at least looking at this. Again, I'm not here to change commercial real estate and to change the way this is. I'm just here to encourage people to understand that there is a strategy that allows people in my profession to not just be a cost center for you.
Yeah.
That I can help you kind of get into, maybe it's number 6, maybe it's number 9 once you're two stages down the road. I keep finding good deals. Cool. I'm not trying to screw up your good deal on the market. Do it. Mine is a more painful process, but it comes with potentially a more joyous return.
Yeah.
And whether that's owning a property you never could have bought, and running it and kind of continuing forward as you described, either refining with the borrower or taking it over and putting management in place, or just owning it outright. You buy, you do it in an apartment building that you see down the street.
I love the idea of how somebody that's already got a few multifamily deals under their belt already. They kind of know the ropes. My guess is that these sellers of these notes are they going to vet the borrower, the buyer a bit, to saying like, "Hey, do you really know what you're talking about? Do you really, let's make sure that you're for real," kind of thing. And if you walk in the door with nothing, with not much to point to track record wise, this strategy is likely not for the faint of heart. So you probably shouldn't do this. You probably go do a deal or two and then get into the strategy, which I really like. But it sounds like this is for someone that's got a few notches under their belt, multifamily wise, maybe looking for something in markets they own already, so they can leverage their resources, leverage their contractor relationships. If they need to take the property, they could use the contractors they're already using on unit turns. Maybe use the property management company that already manages the property they own already. Or if they're sophisticated enough, a lot of these best ever listeners, Chris, own property management companies. They own the company. We own a property management company that runs our assets.
Exactly.
So, right. So then you could just parachute them in, go to what you would call receivership. If we need to unpack that, we can. But receivership, I'll just say quickly, is what happens when a lender has the right to put its own management company in place so it can receive rents and whatnot. Pretty much all the money that comes in goes to the lender at that point, right?
It's kind of like an intermediate step. If you don't want to get as aggressive to move into foreclosure, you move to receivership. Sometimes you can even get the borrower to agree to it because they don't want to foreclose. They don't want to lose title. If you think that you could turn it, if it's going to be more of a turnaround long-term process, then sometimes that's a better thing. once more, I mean, that's a great point by you, and kind of just shows your expertise in this. Like, that's a great way to kind of dip your toe into using litigation affirmatively, because it's going to still be filings and force feeding it. Most people don't want to be in receivership because they lose total control.
Oh yeah. Yeah. I mean, you're going to lose. My guess is in receivership, Chris, like you're also going to go to use more terms, right? But let's educate the best ever listeners. You're also going to go to something called cash management, which is no fun, right? A cash management is where typically, best ever listeners, when you own a well-performing multifamily, the dollars come in from tenants. They touch the hand of your property management company and they pay your bills. And then once all the bills are paid, you pay your mortgage and it's all done. And then you get the rest, hopefully, in upside cash flow to pay your investors and yourself, right? Cash management pretty much turns that whole equation upside down. And it says, okay, the dollars are going to come in. Maybe you're lucky enough to keep your property manager in place, or maybe if you're really up the creek, so to speak, you're a new property manager gets parachuted in called a receiver, right? Then the dollars come in from the tenants, and all those dollars go to the bank first, right? And the bank gets their pound of flesh first. Then you get to pay your bills. Then you get, God bless if the sun's shining just the right way. Maybe if money comes in above your expenses, and the bank will probably make you escrow that overage of cash flow to go back to them for just in case you can't pay your mortgage the next month. You know how it goes, Chris.
Yeah, the old lockbox.
Yeah, right. It's a lockbox, cash management. So that means that like the owner's capacity to take any money at all out of the asset in cash management or lockbox situations is pretty much zilcho. The bank, in essence, becomes the cash receiver of everything, and they decide how much they're going to give you to pay your bills. Likely, what you're going to have to do is you're going to have to go raise money from your investors just to pay your bills and get yourself out of cash management, which you'll have to do through somehow or another, occupancy increasing or whatnot, or getting the property to perform a little bit better. Did I summarize it properly, Chris?
Yeah, exactly. I mean, that's it's one of, I mean, it's a very convoluted process on the cash
it's
management
hell on wheels
side.
what it is. And unfortunately, I'll admit, truth here to admit, we've had assets in cash management. We're lucky enough that we got them out of it but it is not a fun place to be for anyone. So you should hope and pray you don't end up there. But if you are a debt provider, and if you buy a lien like Chris is talking about, there's a lot of recourse that are there for lenders. You can drop in cash management. You can drop in receiverships. Chris, do most loan agreements that you see allow for these vehicles? Or should someone that's looking at getting into this business read that mortgage note with a fine tooth comb to make sure these things are even in there?
Absolutely. I would definitely, I mean, that's where, again, kind of a team, I mean, depending on how big and how much capital you can deploy, but a team of attorneys is helpful. But that's also why having some experience, having some deals under your belt is useful, because you need to know, back and front, what covenants you really want in there and what you don't, right? Because if you're trying to take over a property, you don't have a covenant that you can enforce. Say they get performing again, and you were just depending on doing a straight default on payment. But their NOI is fine, so you can't default them on a debt service type covenant, and that basically means that their net operating income is sufficient.
You can't call them in default. You can't go at them and say, hey, you didn't say Simon Says. No, actually, we did say Simon Says, and our property is performing financially, and you can't go and take me to default, which then allows you to do all these awful things I just talked about: cash management, receivership, all that stuff. So maybe they are performing well and they're paying you a monthly payment, which is great. But maybe, as you said, the returns that you want to make are not structured with them. You don't want to make I don't want monthly payments. I want the property because I told my investors we were going to get the property this way. So could be an interesting scenario, right?
Absolutely. And that's the scenario where then they look at you and they're like, you told me. And that's why getting in a little earlier is sometimes helpful, because you could help them. But conversely, there's also opportunities once you own the note, if you wanted to kind of employ what you were talking about earlier, is renegotiating with the borrower. There's opportunities for you as the note holder. If you want to renegotiate, you can go ahead and throw more covenants in there. Hey, I'll extend out your term, but I'm going to add a rider for receivership. Sure. And you can't object to receivership if, X, Y, and Z. If if you continue to be an NPL for the next, 4 quarters or the next, 6 months.
I mean, the absolute, hand grenade in our industry, Chris, has been these floating rate mortgages, right? And so I would suspect that someone that's buying this kind of debt and you wanted to do a workout, if your end game was to say, I'm going to buy it for 65 cents on the dollar, I'm going to get it performing again by holding hands with this borrower and getting them performing again, and I'm going to sell it for 90 cents on the dollar, right? So I'm going to make a 25% spread, right? My first angle would be, if it were me, to say, okay, Mr. and Mrs. Borrower, here's what I'm going to do. I know you're on this awful floating rate debt. Here's what I'm going to do. I'm going to fix you at 7%, right? I'll make it up 6.5%, 7%. If I want to be nice, I'll do 6.5%. Because that interest rate, as I said before, is on the full par value. And so I'm probably making a pretty good return on my money. And then they're, okay, I could do that. I would go current again. You dangle that carrot out there, and they sign off on all these new covenants that allow me to have some teeth, right? But hey, I hope they get current, because then once they're current, I can sell. I can maybe encourage them to, hey, what if I gave you a payoff at 90% of par? Now you're current again. You're healthy. You're making some cash flow. What if you could refi out? That could be a good way to make a 25% spread on your money without having to take the asset back. You just kind of help the borrower get back on their feet. You can tell
Absolutely.
You can tell I'm a softie, Chris.
Yes and no, until you said I'm going to stick in all these covenants. I'm like, thank you.
Just in case.
That's why you need me. I want to get all the covenants in.
Yeah. Well, you never know, right? People are great.
You're taking all the risk.
Yeah, right.
If you're going to employ that strategy, you're taking all the risk, and you have to be prepared. In my sense, you always have to be prepared to kind of, to shoot the bullets when you have them.
Absolutely. So one last question. I have two last questions for you before I let you go here. If I'm buying a portfolio, I don't know, $5 million, $7 million, whatever it is, can I borrow against that, or do I need to produce all the equity from my investors to go and buy that? Or is there like I said, can you like borrow money to buy borrowed money? If that makes sense.
It depends on who you're buying from. It depends on, how secondary, right? How many levels from initial you are. It depends on your bank. And that's, again, where, your relationship with the seller is going to matter. Because if you're good for it, right? If you have no dollars and you're 100%, cash flow dependent to take a line of credit out to buy this, it's a dangerous industry for everybody to be in.
Sure.
Now, so long as a bank and I'm not the one, throwing lending you that line of credit to buy it, I don't really care, because I'm going to get paid. But as an investor, I don't know if that's necessarily how I'd want to structure that strategy. I think that having, at least the majority of the capital in place to be able to employ this, because you have to realize your carry costs could be 18 months. And say you buy $8 million of non-performing loans in New York City with, 20 million is the kind of the end value that you want, whether it's through sale, whether it's through takeover, however, but you have this huge upside. Well, you now need to carry those properties through. You need to carry it through the foreclosure process, which can be extensive, and then you need to carry it after. Returns aren't going to be immediate. So, I generally would not recommend buying on borrowed.
It sounds like the debt. You was
debt on debt is dangerous.
Well, yeah, you want to talk about having teeth, man. I'll bet you that those debt on debt mortgage agreements are probably 7 or 8 inches thick, and they probably have plenty of teeth. Talking about receivership and cash management and all that jazz, like they're probably in that game to take the debt. They want to take the debt from you. Like they hope you sneeze the wrong way. As we wrap here, give me like a really juicy. Just tease the best ever listeners a little bit. Give us some juice, not like $50 million New York City stuff, man. Give me something that's accessible to me and the best ever listeners here. Tell me a story without like without breaking confidentiality, but tell us a story of a deal that you've seen go to fruition to tell us what's possible in this industry.
So kind of below that, I mean, unfortunately, because I'm in New York City, most of the deals I see are in that kind of 9-figure realm.
Okay.
Just because you have a lot of private equity. Nowadays, there are certain private equity funds that are just doing this. They are pure. They're kind of cast-offs from distressed debt. So, as your listeners probably know, like distressed within hedge funds or mostly hedge, distress is a big thing, right? Your Elliott Capitals who are investing massive amounts of distress. So when you're in distress, there's this cast off into the real estate side. And that's what I've seen. And if you look, if you follow the real deal, you can see very, very recently, in a case that I'm kind of one step removed from, but related to Real Deal has
Okay, I
published
can't ask
quite
you
a
to
bit.
talk any details about it, of course, because if it's in the Real Deal, I mean, all the listeners already read about it. If it's
Yeah, so there's a certain fund that bought nine plus figures worth of debt for a number of multifamilies within New York City, and they're now going through the foreclosure process, the auction process, and credit bid and takeover process. I don't represent that fund, nor do I represent the individual they took over from. However, there is representation for kind of a tangential individual. So I'm very, very familiar with that.
okay.
And that's happening right now as we speak. Like as we speak today, I'm sure there are more being filed because those buildings are, talking about $25 to $40 million of debt.
It seems like the private equity firms want to swing long, right? They want to go after 40, 50, 80, 100, 200, $500 million portfolios, right? And I get that. It's that's probably what I would do if I was sitting on $5, $6 billion worth of cash that I wanted to make a good return on too, right? But a best ever listener might not be sitting on $5 billion worth of cash. They might not. Some of them are, I'm sure, but some of them might not be. And so some of them might be able to raise 5 million, 7, 8 million, right? So it seems like my brother-in-law gave me a phenomenal adage, which I've said all the time. There is always room at the bottom. And so if you want to get in at the bottom of this thing, I don't think a private equity firm, unless they're buying a bucket of like literally 100 loans, they're not going to go and deal with a 5, 6, $7 million non-performing loan, right? So if I were a best ever listener right now and I wanted to get curious about this game, that's where I would start. Would you give that advice too?
Absolutely. I mean, this is the middle and lower market in this field. It's kind of across the litigation finance type field is always underserved because everybody thinks it's a big dog playing field. But the majority of mortgages are not for $25 million multifamilies within
They're not.
Manhattan.
Yeah.
The majority of them are for a couple 100,000 multifamilies name the city that's closest to wherever you live. And if you go to, if you have a relationship with your regional bank or your regional credit union, they have non-performing loans. I will guarantee they have non-performing loans. And if I'm answering to $200 million investors, I'm probably not going to be able to sell them on going to Cleveland, Ohio and buying a 6-unit apartment non-performing loan as part of the bucket. Yeah. But if I can raise $3, $4, $5 million, and there are 6, 8, or 10 of those within Cleveland, Ohio, and I know that industry, and I really want to be there for whatever reason, maybe I can. Maybe I can establish a relationship so I can understand, and it will be, as I always say, for kind of that person, it's not going to be your standalone strategy. It's going to be an addition to the strategy you're employing to whatever your portfolio is.
So, loss and mitigation departments at small community banks. You had said, I get it's probably not as easy as going to like nonperformingloan.com, but there are some brokerages and some online mediums that sell these loans too. Would you rather the best ever listeners come to you to hear more, or do you want to mention any of those sites now that folks can check out?
You guys could come to me to hear more. You could Google it. I don't always want to pitch. I mean, you could Google it. I don't like to say the names just because I don't necessarily want to recommend anyone.
Do your own homework, guys, on where to buy commercial distressed debt. That's probably what you want to get and type in there to ChatGPT or type into Google or whatever it may be. And when you guys are ready, Chris, how do people get to hear more about you? I'm very intrigued by this conversation myself personally. I hope that the best ever listeners are as well. And so for those that want to reach out to hear more, maybe they decide they want to make this part of their investment strategy, or they want to fully pivot and go all in with you. How do they get a hold of you?
Sure. So the easiest way is nowadays, right? LinkedIn. My name is Chris Zona, Zona. You can find me on LinkedIn. I actually have a lot of content on there. You'll see the Turning Conflict into Capital 3-part series. You could also find me at my law firm's website. The law firm is Mandelbaum Barrett PC. The website is mblawfirm.com. I'm featured in there. I have a lot of content on there as well.
Very good. mblawfirm.com, or look up Chris Zona. Easy name to remember is Zona. Look him up on LinkedIn. There's probably not that many Zonas in the world, so I'm sure you guys can find him pretty quickly on LinkedIn. Chris, it's been phenomenal having you the Best Ever CRE show today. I am glad I decided to take an interview with an attorney that was not an SEC guy. Thank you for joining us today.
No, I appreciate the opportunity. Always fun to talk about kind of this concept, and I really hope that that our listeners understand kind of that there is opportunity here.
Absolutely. Guys, that was incredible with Chris Zona. I really love that. I'm going to go talk to that guy. Be careful. We're going to watch what DeRosa Group's going to be doing with distressed debt. And I hope you guys do that too. I hope you guys consider this as an investment option. And as I said at the beginning of the episode, observe the masses and do the opposite. This tactic is something you don't hear a lot of people talking about. You know why? Because it's difficult. Because it's not easy. And a lot of people are not going to do the more difficult strategies that might require going out and finding non-performing loans in your markets, talking to banks, going and researching a lot and finding these non-performing loans and poking it with a stick and looking at 30 deals that don't work till you find that 31st deal that does, right? Yes, it's difficult. And that's why people won't do it. And that's why when people don't do it, you can do it. And that's how you build wealth. That's what it's all about, okay? Observe the masses, do the opposite. That is the theme. Get it tattooed on your arm today, guys, because that's how you're going to build real long-term wealth. Make sure you come see me every Friday here on the Best Ever CRE show, or mark your calendar that's when these episodes come out, because that's the truth. And subscribe to the Best Ever CRE show, best show ever. The show, it's all about building your wealth, helping you guys take your companies, your businesses, yourselves to the next level. That's what I got for you today, guys. Until next Friday, come see me then. Have a best ever day.